In other words, artificially moving the market substantially higher on an intraday basis, up or down, and take advantage of that move that's an artificial move in terms of pricing.
So you see no immediate impact on the dollar for now from this piece of news, but all right, we'll keep tabs on that. I will come back to your dollar forecast and your gold price forecast towards the end of the interview, but for now, I want to talk about price spoofing. This is a piece of news that came out just today, actually, or yesterday, rather. From BNN Bloomberg. I'm just going to read the headline again. JPMorgan's big hitters of gold market face trial over spoofing. The former JPMorgan Chase & Co. managing director ran the bank's precious metals business for more than a decade, making hundreds of millions of dollars in profit trading everything from silver to palladium. Now he and two of his former colleagues face a federal jury in Chicago on criminal charges for thousands of so-called spoofing trades, which prosecutors say were used for years to generate illicit gains for JPMorgan and its top clients. This is referring to, of course, a CFTC ruling back in September 2020, and now they're out to going ahead with the prosecution. JPMorgan was fined $920 million for spoofing the precious metals markets. What's interesting is that it's not just one case of spoofing; it's thousands of trades over many years. So we know they've been doing it. There's evidence of spoofing from at least JPMorgan. We don't know about the other banks for now. Maybe everyone's doing it, but we haven't. CFTC hasn't fined everyone yet. But my question is, Gary, what does spoofing actually mean? Let's start by defining what spoofing is from a trader's perspective, and then we can talk about its impact on the gold market.
Well, what spoofing is when a huge hedge fund or institutional trader such as JPMorgan puts a exceedingly large buy or sell order into the market. In the case of a buy, well above the price range. In other words, they're putting a large order in that they'll pull it out before it's executed. And they'll use it to artificially drive pricing higher. And then they'll pull the order out because it has not been executed and initiate short positions. That is spoofing. In other words, artificially moving the market substantially higher on an intraday basis, up or down, and take advantage of that move that's an artificial move in terms of pricing.
Okay. Is that in itself illegal?
If the CFTC defines it as illegal, it is. I mean,
okay.
Obviously, there have been lawsuits. JPMorgan, what was it, a couple of years ago, acknowledged that and paid a fine. This is yet a new case. What it does show is that there have been systemic problems within the system that have allowed these large firms to literally go unchecked. In other words, this wasn't something that they did once or twice.
No, it's thousands of trades.
Systemic over time, over years. And as your article said, it's resulted in hundreds of millions of dollars in profit. So is it illegal? In my opinion, well, it's absolutely immoral. And I believe it is, in fact, illegal to put an order in that you are not intending or not hoping to have that order executed or filled. Okay.
Now, what market participants wonder, Gary, is whether or not this actually has material impact on the price of gold. It's not just gold they were doing it with, but let's just talk about gold for now. They were doing it to a lot of metals. So short-term and long-term impacts, what are they, if any?
Okay, the first thing, gold, platinum, and palladium are all markets that have seen this activity occur. The thinner the liquidity in a market, the easier it is to spoof because the quantity can be smaller and have a more dramatic impact or move pricing. The larger the liquidity or open interest within a commodity, the less effect a order will have. You have to have a larger quantity for it to have that same effect, to rise prices, say, intraday by 0.5% or 1%. On a short-term basis, it absolutely has a profound impact on the market. As a trader watching the market for 30 years plus, I've seen it occur, but I didn't know what was occurring. In the eyes of a trader, what we see is all of a sudden there's a huge spike in pricing. And when we look through any kind of new fundamental event that might have shifted market sentiment that quickly, there's a void of information, and then the market settles down. The way I look at spoofing is short-term, it has a defined and immediate impact. Long-term, it does not, because long-term, once they've made their move, it's a short-term move that they're looking to accomplish to make these profits. And over time, the market will go where it should go based on overall market sentiment of the group of traders and not a single trader or a couple of traders.
Okay.
Short-term, yes. Long-term, not so much.
Yeah, you'd have to do this on a basically minute by minute, every single day basis in order to sustain any sort of price, either suppression or elevation long-term, right? It's not very easy.
That is correct. And
yeah,
that is correct. And if you recall, there's a very large trader, George Soros, that was very involved in trading currencies. And there was a point in time in which he went eye to eye, or toe to toe, I should say, against the Bank of Japan. The Bank of Japan was trying to support the yen. Soros was shorting the yen. And his comments were that the Bank of Japan could do whatever they wanted to, and on a short-term basis, it would have an effect. It would be supportive for a short period of time, but that the yen would drop if the fundamental reasons that the yen was going lower continued to be prevalent in the market. In other words, it could not have a sustained effect, and even a government cannot artificially manipulate their currency over a long period of time, while they can have an effect on short-term strength or weakness within a given currency.
Okay. So can you just go back to the long-term impact one more time? So why is it that price suppression on a long-term basis is difficult to attain, Gary?
Well,
not just suppression. I mean, just manipulation in any direction. Suppression is just keeping it down. We can keep it elevated if we want, right? In theory.
Right. Well, the idea behind having a spoof trade is not a long-term scenario. They're looking to artificially prop up the market, where you see gold spike up $30 for no fundamental reason. The people initiating the spoof go in and sell the market at the top. And that, of course, will put selling pressure and bring it back into alignment. In terms of a long-term basis, the only example I can give of something of a commodity or a currency, which is a commodity in which an entity is trying to fix the price, support it for a long period of time, is a country, a central bank. And you'll see that when you have weaknesses. The example I gave you, when the Bank of Japan tried to maintain the Japanese yen at a certain level and it continued to drop. You will see something over time. An attempt can be made by a country, but not by individual traders. JPMorgan just isn't big enough. There is no single entity, because when you look at what the open interest is in any stock or commodity, the effect that even a large institutional trader such as JPMorgan will have over time will not work, because the pool of traders that are trading with the spoofer will naturally take gold pricing back to where it should be based on real market sentiment, and not an artificial move by a large order that's put in. Because realize, once that order is taken out, it changes the dynamics of the market, and it's taken out at the same point when the spoofer will sell into a market after they put a fake order in above current pricing, and then take it out as they initiate the short position. So by the nature of the technique, it's not going to be a long-term move in the market. So you'll see gold artificially spike up $30 or $40 and then come back into alignment, because once they take that buy order out of the market, or as price goes farther away from it, it becomes less likely. And to achieve profits on the artificial manipulation of moving the market higher, they've got to initiate a short at where they think the top of the range is going to be. and the large buy order has been taken out, and they're actively selling the market.
Okay. Well, Gary, you look at charts, every single day of your life. Do you ever see a particular price movement within, let's say, an hourly, or let's say even a daily basis, and think to yourself, this doesn't make a lot of sense. There's something fishy going on. Perhaps it's spoofing. Perhaps it's large trades, not several blocks of orders being placed that are irregular. Does that ever occur to you, Gary?
Well, I've seen it happen more than once. And really, you're never aware of it at that moment. You think, wow, this is strange. In other words, you see a intraday move where it's a tremendous spike. Within a 5-minute period, you'll see gold rise, say $30, $40. And then when you run through all of your different news services and wire services to see if there's a fundamental event that has shifted market sentiment, then you realize that it's incongruent with what you've seen in the market. In other words, if the Federal Reserve came out and made a statement that they're going to raise rates at the end of this month by 1% or 1.25%, and everybody is anticipating or baking in the high probability of a 75 basis point hike, that's not artificial, and that will be sustained because it will take a couple of days for this change in market sentiment to kind of work its way through the market. So what you typically see with a spoofing scenario is a very, very short-term move in a market. I've seen it, I don't know how many years ago, but it was during a holiday weekend in which it would be I remember one instance of spoofing occur on a Thanksgiving. Was it a Thanksgiving holiday? It was, in other words, where in the US markets were closed.
Right.
And the volume was very, very thin, even after they opened in Australia. And they took advantage of the thin volume in trading because of the holiday. And they could place a smaller order than they would in a normal trading environment to move the market in the direction they wanted it to go before putting on the opposite end of that trade.
You'd imagine.
So we have seen.
Sorry, please continue. Sorry.
We have seen that occur. I personally have seen that occur on more than one occasion.
Yeah.
But you have no knowledge that it occurred till after the event. In other words, it's a move in the market that isn't backed by any fundamental, any change or dramatic fundamental event that wasn't present 10 minutes before the spike, let's say.
I was going to say, Gary, you'd imagine this to happen with a commodity or an asset that's not as liquid as gold. I mean, gold's last I checked, what, $11 to $14 trillion market, depending on the price of a given day. It's not a small commodity. I mean, you'd have to really put in a lot of trades to move the price.
It's the size of the spoofed order. In other words, you have open interest, and the definition of open interest is for every every contract that's a long and every contract that's a short, you have an open interest of 1. Then you have volume, and volume is the number of trades placed that day. And so with gold, typically it's over 100,000 per day, up to 250,000 contracts traded in a single day. That's contracts. So if you're putting in an order for 50,000 contracts, let's say, well above where the market is, that's an example of how you would create a spoofing scenario. It's an exceedingly large order in terms of the size of the order. And that's what kind of shakes the wheels up to make it spike higher, is it's got to be an exceedingly large order compared to daily volume.
Okay. Well,
which is why, and I'll leave it at that, which is why in something like palladium, which is a very thin market with very low liquidity.
Yeah.
In other words, the open interest is small and the number of contracts traded each day is small. It's easier to create that scenario than something like gold, and near impossible to do it in bonds because of the huge amount of open interest and volume. And that's why it occurs in the metals and not in the larger commodities such as debt instruments, US debt.